Warren Buffett's top 10 investing mistakes and how to avoid them. When he was only 11 years old, Warren Buffett purchased 3 shares of City Service Preferred. By cashing out shortly afterwards, he was able to make a minor profit. However, once the stock price started rising, he realized the significance of keeping his investments. Let me give you a figure that'll blow your mind. I think I bought my first stock when I was 11 years old. It was the first quarter of 1942. Shortly after Pearl Harbor, I spent $114.75. 3 shares out of 114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today. Okay, the answer is about $400,000. So if I was a little kid, I'd tell you that 114 bucks, I'd say the shuffling snow or whatever I've done. $400,000 today, one person's lifetime. That's America. Warren Buffett is one of the most successful investors ever, yet even he has made missteps in the past. This just highlights that even seasoned professionals make mistakes from time to time. In his renowned yearly letters to Berkshire Hathaway shareholders, Buffett discloses information about some of his worst investment choices. This video will give you an insight into some common mistakes that investors often make while constructing their portfolios. Be aware, as you may be making some of them too. So it's best to watch out. Timing the market. Forecasting stock market trends is an extremely difficult thing to do. Even experienced investors often struggle with it. Many aspiring traders have unsuccessfully attempted to make accurate predictions in terms of the market's behavior. Buffett recommended that investors should put in the effort to research individual companies instead. He used the example of his investment hero Benjamin Graham as a case study. He believes that market timing should be a part of every investor's strategy. The idea being that when prices drop, a quick purchase can be made, and when prices peak, selling is encouraged to make an optimal profit. Buffett proposed that instead of trying to time the market, investors should put their focus on consistent and reliable variables. Buffett pointed out that when you stop trying to predict the stock market and instead focus on building a strong strategy, you're more likely to find success in your venture. Because you are no longer aiming specifically for a particular result, rather remaining flexible to whatever situation requires. Leveraging. According to Buffett, the only way an investor could face trouble with their investments was when they borrowed too much money. If you're an investor and are caught in the middle of a major financial disaster, you may end up losing all your investments. Making decisions on the financial market is like playing Russian economic roulette. You never know what might happen next. Warren Buffett shared his belief that investing funds that are borrowed as a desperate move in the world of finance is not meant for those who expect instant results. If an investor takes out a loan and is not able to act on it due to lack of accurate information, this can lead to them making losses resulting in bankruptcy. And this is only the beginning of the tribulations they have to face. Looking for the impossible. Investors A and B have their sights set on the same investment portfolio. Investor A is mainly interested in the return on his investment, whereas Investor B's primary concern is how the company will fare in the long term. Who is willing to boldly confront all the challenges of obtaining the asset? That is for you to answer. Buffett accepted that himself as well as other investors can make mistakes. He indicated that majority of the company's wrong decisions were due to incorrect estimations of the economic condition in the industry. An investor must consider the firm's future economics, the management's quality, and the asking price to make a profitable investment in expansion. Once you have taken care of the 3 crucial aspects of a purchase, the minor details should be easy to manage. Buffett's success was a product of his extensive understanding of the business world and his knack for making things uncomplicated. However, you too can close deals in record time just by paying attention to the key details. Emotional investment. If you're going to look at the price of the stock and think that you have to act because it's doing this or that or somebody else tells you why. I mean, how can you stay without them when something else is going up or anything? It really is, you've got to be in the right psychological position, and frankly, some people are not really careful. Some people are more subject to fairer than others. Buffett believes that it is unwise to invest while being too emotionally involved. He suggested that traders should look beyond the current market price when considering an investment and focus on the potential of the company in the future. Following Warren Buffett's advice, investors should envision a blank slate and pretend they don't know anything about the company's financials or how they can get their money back. This allows them to look at the stock with a fresh perspective. The 7-feet jump. What questions do you ask yourself when you want something good? And what answers do you expect to receive? It all does not need to be based on quantity, it should be rooted in quality. If you invest in the right company with potential for growth, you'll be handsomely rewarded for your investment. Buffett compared the difficulty of different tasks to the analogy of earning a ribbon for jumping over a 7-foot bar versus a 1-foot bar when discussing this issue. The former does not guarantee future success when it comes to investing. He claims that making this mistake is so regular that it contradicts the definition of success, for which you would be credited for overcoming challenges. It's not worth the effort and can be detrimental for investment results to attempt complex things like mathematical equations or optimistic predictions of a market's future. This statement does not necessarily apply to the investment sector. According to Buffett, an investor's success is almost certain if they find a company with excellent prospects, trustworthy leadership and fair remuneration. He gave his backing to his assertion by pointing out that even the most basic concepts often result in noteworthy investment returns. Reckoning bias. If an investor is heavily biased towards certain options, they are likely to run into significant issues in the future. Buffett believes that information is the key to success. As an investor, if you fail to examine things from an alternative viewpoint, you can make a huge mistake which will affect your progress not only in investing but also in other aspects of life. Warren Buffett's longtime colleague Charlie Munger makes a comparison. He compared the human mind to the egg, likening it to the female reproductive system. He suggested that, similar to how a single egg can only be fertilized by one sperm, so too does the mind shut down when one thought enters in order to prevent a second from entering. Therefore, investors shouldn't selectively absorb and reject information because it can have serious consequences. Charlie Munger emphasized the importance of avoiding biased information and staying rational while assessing the companies in your portfolio. This way, you can adequately weigh out both the pros and cons of any investment opportunities, which can help you make advantageous decisions. Limiting the range of possibilities available. It's important to acknowledge the difference between being knowledgeable in a particular area and being narrow-minded. Warren Buffett has mentioned to investors that possessing an open mind can offer them potential rewards. Opportunities can appear anywhere. It often directs you away from comfortable zones and towards destinations which may seem unreachable to the masses. You should never assume that investment opportunities will always be available when you need them. Don't take them for granted. He insisted that one should not limit their alternatives, similar to how fishermen and investors do not stay in one place for too long, as opportunities come and go unpredictably. Different directions. Warren Buffett believes that diversifying too much is one of the biggest errors an investor can make. He suggested that 6 enterprises was a great number when you're an investor who understands business. However, where they make a mistake is when they choose the 7th business over reinvesting into the first one, and this could have fatal consequences. Although only a few have been able to make it big through their most brilliant ideas, a lot of people have still achieved greatness by fulfilling their greatest ambitions. Investing in a diverse portfolio, like an index fund, is a sound and wise decision as it offers protection against unwise investment choices. I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into an index fund in relatively equal amounts over it, 20 or 30 year period, I would pick it. Final notes. Paying more money than expected for educational fees is never an enjoyable experience, but not every financial mistake has to spell complete disaster. One way to make up for any losses is by evaluating what went wrong and taking measures to ensure that the same mistakes are not made again in the future. Even Warren Buffett, who has had remarkable success in his career, concedes to making mistakes. Just like renowned investors, you are bound to make mistakes in investing. When you face a setback, stay positive and keep your focus on the long-term goal. That concludes our video on recognizing the drawbacks of investment practices. We'd love to hear your ideas and reflections in the comments section below. Please feel free to interact with us by liking and subscribing. Till then, take care. Goodbye.